So we'll start with arguably the most important reading of the CFA Level 3 curriculum, that is reading number 10, that will tell us about how to manage individual investor portfolios. This will be the heaviest weight on the morning type exam, and this section is often the difference between passing and failing on the Level 3 exam. So make sure you understand the concepts well and you practice a lot of cases and a lot of item sets on this section, especially because of the 35 readings of the curriculum. This reading by far is the most important. So we'll start with an introduction and also emphasize the importance on the exam of this section. Understand the concept of investor profiling. Understand the various personality types of individual investors. The very important concept of the investment policy statement. Construct the risk and return objective on the policy statement. The various constraints of the policy statement that we will see. Understand how to pick an asset allocation that is suitable to the client. And most importantly, wind up with many different examples that will tell us how the concepts will be tested and how they will be answered on the exam. So please remember that about 35 to 45% of the essay type section is expected to be directly related to this reading. So the questions normally have subparts, and the essay type paper will have 180 minutes. Each minute will be equal to 1 mark. So the time allocated to the subpart is the maximum score that you can get on that subpart. So that's true for the entire essay type section on the morning. What you need to remember and what you need to emphasize is that each individual is different. Hence, there can be practically an infinite number of different cases and different issues that might occur and that you need to be familiar with. The only way to get this familiarization is to solve many different cases. Use the help of past exams, other sources. If instructor would have sent you their material, so devour the item sets, practice as much as you can. At the end of the day, that's the only way to gain mastery of this reading. So caselets in this section will often try to confuse you. So you will have contradicting information and you'll have to pick the best option. So carefully understand the facts and determine which issues are relevant and which are not. So the CFA Institute specially warns us that the level 3 exam is unique, that it requires a high level of judgment, and it is in questions on managing individual investor portfolio, ethics, etc., where this judgment comes into play the most. So guys, the answers to your questions have already been decided. Make sure you practice writing an effective constructed response that supports your answer and supports the points in an efficient manner. We'll do some examples and explain how best to formulate the responses to this section. But again, practice is the key. So to begin with, we would like to understand our client and construct a situational profile of the client. This essentially is done to give us some indication of an individual's risk tolerance, that is his ability and willingness to take risk. So you need to first understand what is the source of wealth of the client. If the source is active wealth creation, something like wealth accumulated through entrepreneurial activity, or through investments in venture, or through investments in private companies, etc., then this kind of source of wealth may normally indicate an above average willingness to tolerate risk. However, do not simply look at this aspect and conclude above average willingness. Do look for other statements and actions that confirm this assumption or invalidate it, as may be specific to a case. So generally, when an investor comes to you, it is because he has some accumulated wealth, and your job is to effectively invest and allocate that wealth for him. Before you start investing that accumulated wealth, you need to understand the source of the wealth, If it is active, it indicates an above average willingness. If it is passive, that is, wealth has been acquired through inheritance or a windfall gain or through a lifetime of secure employment, then this may indicate a below average willingness to tolerate risk. So the first section in investor profiling is to understand the source of wealth. The second section is to understand the investor's measure of wealth. Please note, the measure of wealth is not the absolute wealth that the client has. It is the investor's perception of his wealth. So how much does he think that his wealth is? Generally speaking, there is a positive correlation between a client's perception of his wealth and his willingness to take risk. So if he thinks his wealth is high or large, he'd be willing to assume more risk, because even if he loses some of it, it does not really impact his lifestyle. If he feels that his wealth is small, then he would be less willing to risk a lot of it. The last section of investor profiling is the investor's stage of life. So investors in the younger stages generally have a higher ability to add to their portfolios from employment, income, and they have a higher ability to recover from short-term downturns. So they can tolerate greater risk as compared to older investors or investors further down in their stage of life. So the normal life stage progression is from the foundation phase, wherein he is accumulating wealth through employment and savings or building his own business. In the foundation phase, the investor generally has a long-term time horizon. That is, he has sufficient time to recoup from losses if they occur. However, the financial wealth at this stage is very, very low or may hardly be there. Hence, the ability to take risk is slightly reduced because there is very little, and if that is lost, it may be detrimental. However, if in the foundation stage the investor has some inherited wealth or some windfall gain, then that can be invested in risky assets given the long time horizon. From the foundation phase, the investor generally moves to the accumulation phase, wherein his income increases, business success rises, and assets now start getting accumulated. So he has higher financial wealth or savings in the accumulation phase. However, his financial demands such as children's education, buying a house, etc. may also rise. So this is generally speaking between the age of 35 to 45 for most people, and is the time for maximum savings and wealth accumulation with a high ability to take risk, because there's still a long time to go before he retires, 60-65, and he has significant savings that need to be invested. The final stage in an investor's life is called the maintenance phase, where he is retired, and now the focus is on preserving the wealth and living off the dividend income and the capital appreciation of the portfolio to meet your day-to-day expenses. So the ability to bear risk, generally speaking, is declining in this phase because you don't have any supplemental income, you're not employed anymore. However, if you have significant savings by the time you reach this phase, then your ability to take risk may not be very low. Life expectancy can be long and is increasing as healthcare is improving across the world. So we need to maintain the purchasing power of the money. That is, our assets should at least grow by inflation so as to be able to maintain the investor's lifestyle. Some investors may also have a distribution stage wherein the assets far exceed the need for the individual and the process of distribution can already begin. So you can set up trusts or gift assets or make plans for distributing your assets at death. We will study more of these in taxes and estate planning in the coming sessions. So in the retirement stage or the maintenance phase, generally the time horizon is relatively shorter because it is only from retirement to the investor's death. However, if he has significantly higher assets, then the financial objectives may extend beyond death and the time horizon may remain long term with an increased ability to take risk. So this progression is not always linear, the progression from the foundation phase to the accumulation phase to the maintenance and the distribution phase. Any setbacks, a health problem, a loss in some investment, or a windfall gain could move someone ahead or back in time. So to review the process of investor profiling, there are three aspects. You need to first understand the source of wealth. You need to then make a comment on the measure of wealth. Please note, the measure of wealth is the investor's perceived wealth. If he perceives his wealth to be high, he will be more willing to take risk and vice versa. And finally, you have to comment on an investor's stage of life. The younger, the higher the ability to take risk generally. Now, just to revise the concept of traditional finance and contrast it with behavioral finance, decision making in traditional finance assumes that investors exhibit three characteristics. First is risk aversion, that is, they minimize risk for a given level of return, and vice versa. Risk is measured as standard deviation. We studied earlier that behavioral finance argues for loss aversion, and it says that investors may or may not always be risk averse. Under different situations, the same person also can be risk seeking, risk neutral, or risk averse. Traditional finance, on the other hand, assumes that all investors at all points in time are risk averse. It assumes rational expectations, that is, forecasts are unbiased and accurately reflect all relevant information. So rational expectations essentially implies that all investors have all information and hence they have homogeneous expectations about each asset and each stock. So if a particular stock is risky, everybody agrees that it is risky. If something is not risky, everybody agrees. It assumes asset integration, that is, investors consider the correlation of a new asset with their existing portfolios before deciding whether to include it or not. So all assets are considered from a holistic overall perspective, which we will see does not always actually happen because there is mental accounting and there are many other biases that individuals may have. So asset prices in traditional finance are always efficiently priced. That is, they reflect all economic information and portfolios are constructed holistically. Behavioral finance, on the other hand, argues that decision models need to also consider certain behavioral biases, for example, loss aversion. That is, how the information is presented and whether the decision is framed as a gain or a loss also affects the decision. So between a sure loss of $100 or a 50-50 chance of losing $200 or $0, we see that individuals normally choose option B. That is, in this case, they are risk seeking. So in both cases, the expected loss is $100. Option A is a sure loss of $100 and option B is 50% chance of losing $200 and 50% chance of losing nothing. So in such a case, we have normally seen that investors choose option B, that is, they take the risk. However, if we change option A to a sure gain of $100 and option B to a 50-50 chance of gaining $200 or gaining nothing, individuals for some reason now choose option A. That is, they do not take the risk. So they suddenly become risk averse. So behavioral finance argues that investors are not always risk averse. They can be risk seeking also and they can be risk averse also. What we have generally seen is that people are loss averse, so they do not like to accept a sure loss. When presented with the possibility of a sure loss, they may want to take excessive risk so as to try to get out of that loss. It argues that people have biased expectations and not rational expectations. That is, there are various biases that we studied earlier. So these could be from cognitive factors or emotional factors, anchoring, representativeness, status quo, etc., that affect our expectations and hence affect the pricing of assets. Rather than asset integration, behavioral finance argues asset segregation. That is, investors view assets in isolation and do not consider the effect of correlation with other assets. So asset integration argues that investors consider the correlation of the new asset with their existing portfolios before deciding whether to include it or not. Hence, asset prices in traditional finance are efficiently priced, that is, they reflect all economic information. Behavioral finance argues that people also need to consider various biases before making decisions. So loss aversion argues that people want to avoid accepting a loss. So between a sure loss of $100 and a 50-50 chance of either losing $200 or losing nothing, in both cases the loss is, or the expected loss is -100, we see that people normally go for option B. That is, they take the risk or they become risk seeking. However, if we change this problem slightly, that is, between a sure gain of $100 and a 50-50 chance of gaining $200 or gaining nothing, individuals normally choose option A. That is, they'll choose the sure gain and they will now not take the risk. So behavioral finance argues that people are not always risk averse. They can at times be risk seeking. People have generally been seen to be loss averse. They have biased expectations from the various biases that we studied earlier. And instead of asset integration, behavioral finance argues asset segregation. That is, investors often view the assets in isolation and decide whether they want to buy or not. So investors do not always consider the correlation of one asset with the other. They suffer from a bias called mental accounting. That is, they segregate their portfolio into different goals and each asset is individually purchased to meet a specific goal. Hence, different portfolios are constructed for each layer, with assets in each layer reflecting the priority of its goals to that investor. So what this can do is may result in too many low risk investments for important goals and too many very high risk investments for the unimportant goals, and we are left with less of medium risk investments. So behavioral finance argues that markets may be inefficient as asset prices are affected both by the underlying fundamentals or the underlying financial economics as well as the investor's subjective classifications and subjective biases. So in such a case, too low risk securities may also be highly priced because there's a very high demand. Very high risk investments may also be highly priced because again there is high demand for the less important goals. Medium risk investments may be priced relatively lower because people don't demand them as they don't fit in their portfolio in the process of mental accounting. So behavioral finance argues that people have behavioral biases and hence markets are not efficient. So after constructing the situational profile, we may also be required to classify the investor into one of 4 different personality types. So this segregation is normally done through a questionnaire process. So investors are asked certain questions. A lot of them may not be financial in nature. That is, that try to test whether this person is a risk-seeking person or is a risk-averse person. And then we try to put him in one of 4 general categories of attitude and style. The first is called a cautious investor, who is seen to be the most risk-averse and will generally be easy to identify in your exam. So these investors exhibit a strong desire for financial security. They will prefer very low risk investments with very little potential for loss. They have an inability to make decisions which can lead to missed opportunities. Portfolios exhibit low turnover, they don't like to trade much, and they generally believe that wealth should be preserved and would not want to venture out into anything. The methodical investor still falls in the risk-averse category. However, he is a lot less risk-averse than the cautious investor. So these investors diligently perform research on markets to gather the investment information. Their decisions still have a tilt towards the risk-averse side, that is, they are conservative. Decisions, however, are based on facts and they do not tend to form emotional attachments like the cautious investor. The methodical investor is constantly on the lookout for new or better information. The confusion normally will be between the methodical and the individualistic investor who have similar characteristics. That is, even the individual investor does his own research and is fairly confident about his abilities. Individualistic investors, however, fall in the less risk-averse category or the risk-seeking category. So they will devote time to reconcile any contradictions that they have from the sell side or from other people's views or other analysts. They will challenge incorrect assumptions and will be confident in their research process and their method. So when confused between methodical and investor, try to see, is the tilt on the risk-averse side? Are decisions too conservative? If so, then the investor is most likely a methodical investor. If we see high active research and the investor fighting to reconcile various aspects, then he is more likely to be on the individualistic investor side. Spontaneous investors will again be easy to identify. They are the least risk averse and they constantly want to adjust their portfolios to changing conditions. And these changing conditions may often be non-financial or non-economic in nature. So they feel an essential need to be aligned to the new market trend. Reactions are often prompted by irrelevant and non-material trends such that they tend to over-manage the portfolios, leading to high turnover. So these are the 4 personality types: cautious, methodical, individualistic and spontaneous. We'll understand better when we do examples. So once again, methodical and cautious fall on the more risk-averse side. For the methodical investor, decision is primarily based on thinking. For the cautious, it is primarily on feeling and not so much on research. The individualistic and spontaneous investors are less risk-averse. Individualist, however, has his decisions primarily based on thinking. The spontaneous mainly trades on feelings and new trends. So we'll now move on to understanding and defining arguably the most important concept of the level 3 exam, that is called the investment policy statement that you as an advisor are required to construct in consultation with your client for your client. The investment policy statement and the process of developing the investment policy statement is valuable for both the client as well as you as an advisor. So it contains the return and risk objectives and it describes the client's constraints, as we will just see. The benefit for the client is that it will identify and document the objectives and the constraints that he has. So a lot of times clients themselves will understand themselves better once they think about the questions posed by the IPS and they try to understand their own objectives and constraints. The IPS is dynamic, so changes in circumstances can easily be incorporated. The IPS makes it easy to bring in newer managers. So if you decide to change the fund manager, the new person doesn't have to start from scratch. He will have an IPS to begin with. So very importantly, the IPS is an educational experience for the client wherein he understands himself better. Clients learn more about themselves, They are better able to understand the manager's recommendations and why the manager is doing the things that he is. For the advisor, there is improved knowledge and understanding of the client. It is an indispensable document as it will be the primary guide for investment decision making. The risk and return objectives will drive what kind of asset classes and what kind of stocks can be included or not. IPS further contains guidance for resolution of disputes. It is a signed document that can be used to support the manager's investment decisions in case of any conflict or any challenge by the client. Now for the exam, please remember that there are two sections in the IPS that you have to explicitly address. The return objective and the risk tolerance are the two objectives. 5 constraints include the time horizon, liquidity needs, tax considerations, legal and regulatory concerns, as well as unique circumstances. We'll understand each one of these in detail. However, please make sure that you memorize the two sections of the IPS. Try to answer within the number of minutes assigned to the question. So for the same question, 2 minutes would imply only a brief response. But if 8 minutes were assigned, then that would imply going into more details and substantiating and justifying your response a little more. It is always advisable to read the questions before you start reading the story so that you know what you need to address. As you read, underline the relevant aspects and try to make small notes either in the margin or right on top of where the relevant information is. It will help you in quickly answering the questions. So we will understand this process when we solve a few questions today. Now the first and a very important objective will be the return requirement. So the return generally can be divided into a required return and a desired return. Required objectives will include living expenses, children's education, healthcare, etc. Desired return objectives would be things like buying a second home, traveling across the world, etc. If you think that the client doesn't have a sufficient enough portfolio, you may even choose to ignore the desired return, or you may focus entirely on the required objectives as these are most important. If there is sufficient wealth and there is ability of the portfolio to achieve these desired returns, then of course you will construct an asset allocation accordingly. So required or critical objectives must be met, and how easy these are to meet will decide the risk tolerance that we will study next. So the return and risk objective have to be consistent with reasonable capital market expectations. So if the required objectives need a 30% return, then the client needs counseling and you need to bring this number down, because it is unfair to expect such a high return from any portfolio. So point out any extreme comments which may require counseling and reconciliation. Follow a total return approach. That is, do not distinguish returns from dividends, interest, realized or unrealized capital gains. Everything is in your return. So focus on total return. Don't be over concerned with dividends or capital appreciation. Return objective must also specify whether it is nominal, that is including inflation, or inflation over and above this needs to be earned, and whether it is a pre-tax requirement or an after-tax requirement, and you must specify this in advance. So for the exam, please remember that list the required and the desired objectives. Quantify the investable asset base, that is, what is the size of the portfolio, and the numeric absolute required return. So let's say $100 is the investable asset base and $10 is what the investor needs to meet all his required objectives, his living expenses, children's education, so on and so forth. So the investable base will be the current value of the portfolio, and the absolute required return is the dollar amount that needs to be generated in the next year. Ownership of a personal residence is normally not taken in the investable asset base calculation. Calculate a percentage return by dividing the absolute required return by the investable asset base. So in this case it would be $10, that is the absolute required return, divided by the investable asset base of $100, giving us a required return of 10%. Assume that the required return is for the next year unless otherwise specified, and sometimes you may need to do additional adjustments for calculating nominal return or pre-tax return. That is, to this calculation you may need to add inflation or you may need to add taxes. So if 10% is the real return required after tax, then to the fund manager, or how much the fund manager needs to earn, is actually higher than this, because this is what the investor actually needs in his hand. So whatever is the real requirement, over and above that you may need to earn inflation, and over and above that you may need to earn the tax rate. So 1 plus R into 1 plus I minus 1 would be the nominal required rate. This divided by 1 minus the tax rate will give you the pre-tax required return. Again, we'll understand it better with an example. Now for individual investors, on the risk objective section, we need to break it up into two parts. So we will answer it as the ability to take risk combined with the willingness to take risk. The ability can be average, above average, or below average. And the answer to this question will be decided by the ability of the portfolio to sustain losses without jeopardizing the client's required return objectives. So if the portfolio can sustain a lot of loss and still meet the required return, then we will say the ability to take risk is above average. If even a slight loss jeopardizes his lifestyle or jeopardizes his required return, then we will say the ability is below average. So if the required return is $10 and the portfolio size is $10,000, then generally the ability to take risk would be above average. Please note, the institute mentions no number or no minimum required percentage at which we decide it is above average or below average. So there is no such cutoff that I can give you. But generally, if the client is young, he has enough ability to supplement his portfolio from his income and additional sources. And even if the portfolio sustains a slight loss, the chance of meeting this $10 return is not jeopardized. Hence, we will conclude that the ability is above average. So the ability is significantly affected by the investor's time horizon. Longer the time horizon, higher the ability. The size of his expenditures, if it is a $10, it's not such a big deal. If it would have been $1,000 on a $10,000 portfolio, then we would consider an average or maybe a below average, as if the portfolio halves, then meeting $1,000 may become difficult from a $10,000 base. So remember, ability to take risk is increased by a longer time horizon, large size of the portfolio in comparison with the critical goals, and low liquidity requirements. So if the investor doesn't need cash for any medical emergency or for any other critical requirement, then that increases his ability to take risk. Ability is decreased if there is less flexibility in the goals. So goals are very critical. That is, this $10 must be earned under all circumstances. If that is the case, then the ability is lower. If goals can be deferred, the ability is better. If the portfolio is the only source of meeting the living expenses, that is, there is no income coming in, then again the ability to take risk will be lesser. So generally speaking, in the risk objective, you will have one answer as the ability, and you will simply write average, above average, or below average with a one-line explanation or one justification. If the section has 2 points or 2 minutes assigned, then just write above average, average, or below average, and probably give 3 or 4 words or one line explanation. If it has 4 minutes assigned, then you can give 2 points to substantiate your ability. But generally, one small line to substantiate why the ability is high, something like high portfolio size or low requirements, long time horizon, is enough to substantiate your answer for the ability. The ability to take risk will be combined with the willingness to take risk. Willingness again will be average, above average or below average. However, this will be subjective and will not have to do with the size of the portfolio or the financial constraints per se. So this will be determined through an analysis of the client's psychological profile. There are again no prescribed rules. You have to look out for statements and actions made by the client to judge willingness. If he makes statements like there were bad experiences in the past because of which he wants to avoid risky classes, then you would conclude that there is a below average willingness. If he thinks that he likes to make good returns and he's seen his friends become rich investing in stocks, then that's an indication of an above average willingness to take risk. So you will mention the ability, you will mention the willingness, and then you will mention the overall risk tolerance. That will again be average, above average or below average. Always honor the more conservative of the two. So if willingness is lesser than ability, go with willingness. If ability is less than willingness, go with ability. Point out any conflict between willingness and ability. And normally that is where the answer to this section will end. So there will be ability, willingness, and overall. In some instances, client may specify a maximum shortfall risk. So a client may specifically mention that standard deviation can't be more than this, or 2 standard deviations cannot be more than 30%. If the client has mentioned something like this specifically, very rare, but if he has, then you can also include this one line in your risk tolerance section that client has mentioned he doesn't want risk more than 30%. After we are through with the objectives, we need to address the 5 constraints. That is time horizon, tax, liquidity, legal and regulatory, and unique circumstances. So the time horizon is the total number of years the portfolio will be managed to meet an investor's objectives and constraints. 15 years or more is considered as long term. 3 years or less is considered as short term. Time horizons generally are multi-stage, and normally an investor has at least 2 stages that we will discuss. So a stage in a time horizon is any time where the portfolio allocation is expected to significantly change, or the circumstances of the individual are expected to change so as to reevaluate the IPS and reconstruct the portfolio. So for example, in the case of a 40-year-old investor who will retire at the age of 58, there will be 2 time horizons. One from 40 to 58, that is 18 years until his retirement, and then 58 to 90 or 58 to 95, whatever is the period from retirement to his death. So we will write the answer in the exam as long-term time horizon with 2 stages, 18 years to retirement and retirement of 25 to 30 years. The other parts of the IPS, including the risk and return objective, will be for the first stage that we are constructing the portfolio now. So prior to his retirement, he will meet most of his expenses with his salary. After retirement, it is the portfolio that will meet everything. Hence, the allocation is expected to significantly change. So this will be a relatively simpler aspect to address. Normally the time horizon will be long term and there will be 2 stages. If he is about to retire very soon, then the time horizon may be short term. Retirement generally will be 25 to 30 years for all investors. So just write long term time horizon, 2 stages, 18 years to retirement and so many years after retirement. So state the number of stages in the time horizon, the main objective of each stage, and the number of years in each stage if identifiable. Look for stages defined by people around the client. So if a large future inheritance or a windfall gain of some kind is expected, then when that happens, after that point onwards also the allocation may be different, or even that may usher in another stage in the time horizon. Significantly wealthy individuals may have multi-generational time horizon as well. So their portfolios may need to be managed even after their death for their grandchildren and for trusts, etc. Now, although tax considerations are very important for individual investors, as most individual investors will be taxable individuals, for the perspective of the exam, you are not expected to be a tax expert. So various strategies like tax deferral, tax avoidance, tax reduction can be reduced and will be discussed in more detail in reading 15 and reading number 16 of the curriculum. On the IPS, however, you are not required to be a tax expert. So normally just state that tax considerations are important, and if too much complexity is given, then advise counsel with a tax expert. So typical constraint will be something like individual is taxable at 35%, tax considerations are important. If too many tax statements you see in the case, then just mention that seek qualified advice or advise counsel for tax issues. The third constraint is that of liquidity. So liquidity is the ability of the portfolio to meet anticipated and unanticipated cash needs. So the assets that are a part of a portfolio will be liquid or illiquid depending on how long it takes to sell them and receive the cash. If the price volatility of the assets is high, then again liquidity is normally low. Your client will need liquidity for his living expenses. He will need it for some emergency reserves that he may want to hold. Generally speaking, you should not hold more than 3 to 6 months of the annual distribution as emergency reserves. So as if 10% was the required return or 10% is the living need, then not more than 6 months should be held as liquid cash, because these would create a drag as they will not be invested and they will not be generating the optimal return. Need may also be a one-time or an infrequent negative liquidity event, for example foreign vacation or some healthcare expenditure that needs to happen, some operation or surgery that needs to be done. So try to specifically mention that and as to how much and when it is needed. Any positive liquidity aspects can also be noted here. So they're noted in unique circumstances also, but they can also be noted under liquidity. For example, some wealth expected from inheritance or some other windfall cash coming into the portfolio. Again, you may want to mention the illiquid assets in your portfolio, those that are difficult to sell or that you are restricted to sell, or some assets that have a very large capital gains. So if you sell them, you will have a huge tax liability. So it is not optimal to sell these assets. Can also be noted under the liquidity section of the constraints. If the client owns a home that is a significant part of his portfolio, then that's also an illiquid asset that could be mentioned in this section. Generally speaking, ongoing requirements for living expenses are assumed. They do not need to be additionally mentioned. So for the perspective of the exam, the need for ongoing distributions is generally not required to be listed. Very important is these one-time and infrequent negative liquidity events that need to be noted. So again, be specific on how much and when it is needed. If an outflow will occur immediately, please note that it should also be deducted from the investable base in calculating the return requirement. Emergency cash reserves of 3 months, 6 months, again, do not need to be listed unless the client specifically demands those, or there is a specific need to mention that from the case study or the question data. Illiquid assets, a home, or those where a large tax liability would accrue can be noted in this section as discussed earlier. Ownership of a home can also be noted. The fourth constraint pertains to legal and regulatory factors. So again, there are many situations related to personal trusts, foundations, etc. that can be mentioned in the exam. Again, these constraints may vary greatly and they will typically call for legal advice. Again, like taxes, you are not presumed to be a legal or a regulatory expert. So, for the perspective of the exam, in an individual case study, the answer normally always to this section would be that the prudent investor rule applies. The prudent investor rule states that you should manage the portfolio with ethical responsibilities, with competence, and you should understand your fiduciary responsibility, manage the portfolio on an overall holistic basis. We will study the exact definition in institutional wealth management, but generally you just need to note that the prudent investor rule applies. If there are more details mentioned or more complexities mentioned, then you can just write that legal counsel is advised or the need to seek qualified expert advice. The last constraint is referred to as unique circumstances. So anything important that you have hitherto not mentioned that can affect the management of the assets and has not been covered in any other constraint should be noted in this section. So in the past, special investment concerns, restriction on certain asset classes, etc. have been mentioned. There are special instructions given so as to gradually liquidate a holding or gradually sell some illiquid asset. Restrictions on the sale of assets, asset classes that the client has specifically forbidden. You may also want to mention any assets held outside the investable portfolio that you have not considered. For example, a primary residence, etc. Desired bequests that the client intends to leave for his children or other individuals or charity. Any desired objectives that you didn't consider earlier because they were highly unreasonable given the capital market expectations and given the portfolio can also be mentioned under unique circumstances. So these are just some examples. Anything that you feel needs mentioning and hasn't yet been mentioned can be mentioned under the unique circumstances for the portfolio manager to be aware of. So once you have created the portfolio for your client, you will have the risk tolerance, you will have the return requirement, and you will have all the constraints. As a follow-up to the IPS, you may often be asked to pick a strategic asset allocation. So we will study the concept of asset allocation in a lot more detail in the future. However, from the perspective of the IPS, you need to follow a process of elimination. That is, amongst the given portfolios, select the portfolios where, first of all, the return objective is met. So any portfolio that has an expected return lesser than the required return needs to be rejected upfront. And then you will check for the other constraints. That is, liquidity requirements must be met. Risk tolerance should be in line with what you have just discovered or what you have just noted in the IPS. Always strive to hold as minimum cash after you've met the liquidity requirements or the minimum required. Check for any limits on particular asset classes. See if the returns mentioned are before tax or after tax. And these steps should generally be able to help you pick the best portfolio amongst the given options. Again, we'll do an example and explain this better. Now when computing the expected returns, the risk tolerance, etc., we can follow the process of deterministic planning, wherein we use single estimates or point estimates for economic and financial variables. So risk is estimated by a standard deviation, expected return is calculated as a percentage. So these are basically point estimates. We can also take help of the Monte Carlo simulation approach, wherein various distributions go in as input and the associated probabilities are then calculated so that the return is not a single estimate, it is presented as a distribution, and the risk of extreme events can directly be seen and can be calculated as a probability. So rather than giving a point estimate for the return, we can present a distribution of returns so that the client can better see the expected value as well as the possible extremities. Again, a probabilistic forecast will have advantages because it better indicates the different possibilities, and instead of a yes-no type comparison, investors can actually see the different values of the portfolio under different circumstances. Again, the simulation can better show that even though in the short term the portfolio may have volatility, over the long term better returns will be realized if the investor sticks to the advised allocation or a particular allocation. Monte Carlo approach is able to better incorporate tax calculations and tax nuances, and it will better model the complications of future returns by incorporating the compounding effect of reinvestment. So if returns are low, then they will have a significant impact in the future because the low return will get compounded and the eventual result may be far different from your expectation. Whereas if the return is high, so instead of an 8% you earn 10%, then even though in a 1 year basis it's just a 2% difference, when compounded over 10 years, this difference can widen quite significantly. All these factors can be better explained with Monte Carlo simulations. The disadvantage remains the same, so like any complex model, the output is only as good as the inputs. So if the modeling is not perfect and the distributions are not well thought of, then the results may not be useful. So simplistic use of historical data going in as the input, not customizing the model enough so as to meet the needs of a specific client, are some issues that a Monte Carlo type modeling may have. So again, there are pros and cons, but generally this type of an approach will be superior to a simple deterministic single return traditional model.